Welcome back to another episode of SaaS Buyers Club. I'm your host, Omeed, and I'm a corporate and M&A lawyer for SaaS founders. I help them with all things contracts. The mission of SaaS Buyers Club, if you haven't watched one of the episodes previously, is the idea is that acquisitions have for a long time been a black box for founders. And the whole mission of the podcast is to bring more transparency to what acquisitions entail for founders, as well as to bring experts onto the show who can help founders increase the exit value of their businesses. Because I believe anyone who can deliver value to founders out there will help them increase the value of their business, and increasing the value of their business likely means that they're going to increase the exit value of their business as well. So, with that being said, I'm very pleased this week to introduce Katie Dunn from Power to Pitch. She's also an angel investor. She's got 25 years financing over 10 billion in commercial real estate, and just total badass and awesome person. So thanks, Katie, for joining me this week.
Oh, thank you so much for having me, and thank you for the kind words. We got a chance to meet in real life, which was so fun. We had such a fun night. So I'm really excited to be here. Thank you for thinking of me.
Absolutely. And I'd love if you could give everyone out there just a little bit of information. So, you've got 25 years in commercial real estate, 10 billion in transactions. You're now an angel investor. You've got this company, Power to Pitch. What else can you tell us?
My background, yes, is in commercial real estate finance. So I did loans for buildings across the country from $1 million to over $1 billion. And what that really taught me was how to underwrite people, places, and things. And it also gave me the confidence to talk about numbers and money in millions and billions, not dollars and
Mm-hmm.
cents. So that was what really got me interested in investing. I mean, I worked with a lot of really wealthy people, saw how they got rich, basically. And I was investing myself, my salary along the way, anything I could save. I invested in stocks, I invested in real estate, and I even produced a movie at one point. I started working with startups, as I was saying, in 2008 during the financial crisis. I was going to grad school and was working, with a small consulting firm where we worked with other startups. And that's really where I fell in love. And then a couple of years later, started actively investing in them while still working. And then ended up leaving my company to join my partner, Kat Weaver, in Power to Pitch during COVID. I really went deep in startups during COVID. I studied, I took classes, I did a program at Yale. I did all these different things to really get myself educated on the space, figure out what industries I really liked, one being tech and SaaS businesses, and just trying to, learn as much as I can and then figure out a way to help founders using my expertise in understanding how to talk about things. Like, I'd have to underwrite all these businesses in real estate. I would underwrite the tenants of the buildings to make sure that they could pay the rent so that the owner of the building would pay the mortgage. And that's what really got me comfortable in doing the due diligence on these kinds of things. So, plus I just really love learning about people's passions. I don't have the patience to do one thing every single day, to do the same exact thing every single day. In my background, I was always working on 5, 6, 7 deals at a time. So this way I get to still do
Mm-hmm.
that and working with a bunch of different founders. So now our business, Power to Pitch, helps founders get clear on their messaging and put together their fundraising documents so that they show up to investor meetings or grant opportunities in the best way possible to increase their chances of getting investment.
What can you tell the people out there about what they need to know about their fundraising process, their pitch process, that you often talk to startup founders who come to you at Power to Pitch?
The first thing that we always see is people talk about their business using a bunch of buzzwords. We're the only ones doing this. We're revolutionizing the industry. We're best in class. That could be any company. You didn't hear anything that was specific about the company they're building. We always caution people saying we're the only ones doing this because investors that are really deep in certain sectors, they see everything. So they probably see things that you don't even know exist. And because of that, you could get really busted if somebody says, oh, I just saw this same exact person, somebody's building this out of Texas and you're in LA. Like that happens all the time. It's really being careful about the language you're using and using language that's going to allow people to get it right away. Being very specific on what you offer and how you offer it, how you make money, talking about your team. We use very direct language, use stats and facts to back up what you're talking about, especially the problem, especially your traction, especially your revenue plan. It's all about building their confidence in order to talk about their company in a way that everyone will just automatically get it, see the value, and then move on to the next thing.
Okay.
Next conversation, I should say. Because that pitch and deck, that's a one-time thing, right? Everybody puts so much pressure on the deck, which is something that is shown for 15 minutes max and then goes in a file. It's all about the next conversation and the next conversation. So being able to talk about who you are and what you are is way more important. The language you're using, how you're talking about things, than any visual you can ever prepare.
And some of the things I heard you say that are incredibly important are no buzzwords, skip the buzzwords, and then really focus on what's unique about you. Back up everything with stats and facts to the greatest extent possible that you can. These are some of the things that you really make a pitch as strong as possible that lead to the next meeting until you close the investment.
Yeah, I'm sure you see it all the time. Being in the legal space, you see people that want to trademark things or patent things. They may not be as unique as they think they are, or being able to talk about how you're unique without saying the word unique. That's where the power really comes in.
And what's the key to that?
Being very, very, very specific. The first thing we have founders do is they create a 60-second pitch script, and every single one comes back and it's a minute and a half plus. And they're like, I just don't know what to cut. So the first thing that I do is I cut all the adjectives and adverbs. Those aren't needed. It's sticking to the real action items and the powerful nouns that are describing what you're doing. It doesn't need to be fluffy. I mean, I'm not saying every single adjective gets taken out, but the uniques, the revolutionizing, all those kinds of things are cut. Because you want a descriptor, a real true descriptor. In getting that one-liner down, there's a company I invested in, a SaaS company, is a regulatory tech company. So they use AI, another buzzword, by the way. So be careful about how you use it. They use AI to basically scrape the world for any regulatory updates from state, local, federal, countries all across the world. And then they provide that information in a digestible way to people that need to know it. So it's usually a lot of banks, lawyers, people like that need to know that information on a real-time basis because it's going to affect the way they do business. Being able to describe that, like you have a very good idea of what that does now, right? If I said I'm revolutionizing the regulatory tech world by implementing AI in a brand new way that nobody else has ever done, blah, blah, blah. Yeah, exactly. You're rolling your eyes, you're bored, you're like, this is so like, I don't get it. So that's what the transformation that we help people make.
Yeah. And what I heard there, the most important thing, well, obviously the part that stood out the most is cut the adverbs, cut the adjectives, but more so than anything else, it's like just tell people exactly what you do as directly and most straightforwardly as possible. That's interesting that one of the things that I heard you say is like, it's really important actually they show that you're unique without saying that you're unique. And I hear your formula for that is just be incredibly direct, make the person understand exactly what it is that you do within that 60-second time frame, essentially. So really short amount of time, I should be able to communicate to you, this is exactly what we do.
The key here too is you want somebody to be able to repeat it using the same words you do. So hopefully after this conversation, you're going to be able to go out and be able to talk about this regulatory tech company in a way that I just did because I use simple language that's easy to remember. This is a test that I do whenever I'm assessing investments too, is can I describe this quickly and easily? I don't want to overcomplicate myself, and people always ask me about my investments, and I love bragging about them and talking about how great the founders are and the companies I've invested in. They're going to make me billions of dollars, right? That's the whole goal. So being able to talk about it in a way that it's people get it right away. Like I want to be able to be out there being an ambassador for these companies, for these founders, and repeating what their story is very simply, very easily, so that it gets out in the same way. You want everybody on the same page.
Mm.
If one person's telling a story, it's like big game of telephone. You don't want a big game of telephone when it comes to somebody talking about your company. You want people saying the exact same story so they hear it over and over and over again and either want to be a customer or an investor or a partner or whatever it is.
Yeah, I hear communication being such an important piece of the process. Like the way that you communicate may have impact on, you as a founder more than you realize. And I can't tell you how many times I meet incredibly talented startup founders who like, yeah, explain their business to me. I'm like, they sometimes they'll explain their business to me like 100 times and I'll be like, I still don't exactly understand, what it is. I'll have to say like, can you show me, like take
Mhm.
me into whatever your product is and literally like show me what the output is, because like the way that you've explained it up until this point, I'm still confused about exactly what it is that your product does.
And that's the worst. That's the kiss of death because you might not be in a place where you can show them. Your phone might not work. You might not have Wi Fi access. Your deck doesn't work. Your demo doesn't work, whatever it is. So you've got to be able to talk about it. This is why I like lawyers so much because they're like me. They're so direct. They need to get it. We share the same brain in
Mm,
this way. I know that you want to understand. You want to dissect it. You want to make it as simple as possible for yourself. And that's the only way that you can really help somebody.
yeah. Now, our contracts often might say otherwise in terms of the ability
Yeah.
to be clear. It often seems like a lot of lawyers like love overcomplicating their contractual language. Not what I do, but I definitely have seen it. So it's really interesting. What I hear is the whole process and point of the pitch is just to get to the next meeting. And it sounds like the first meeting is all about conveying your uniqueness, what it is that you do as clearly as possible, backing things up with stats and facts. What is the typical process that you've seen for founders? What does the first meeting look like? What does the second meeting look like? How many meetings do you typically see before, the investor decides
It
to, actually maybe get a term sheet over?
So I'll even start with before you get the first meeting because a lot of investors, and I'm not saying don't do this, but a lot of investors want to see the deck before the first meeting. What we always suggest is send them a one pager because you want to present the deck. You are the hero, the deck is the sidekick. You want to be the one presenting it and talking them through that. The first meeting, we always say the rule of thirds. Assume you have 15 minutes, 5 minutes to do the pleasantries, do the intro. Don't forget to ask the investor some questions about themselves, have a conversation. Don't launch right into your pitch. I know you're nervous, but take a minute. They're a person too. Take a little bit of time. You can ask them questions like, what's the last investment you made? Or I saw you were an investor in this company. I really like them because, or, do show that you've done some research on them. Treat them like they're not just a
Mm,
check. So take those first couple minutes to have those niceties. Then say, "Would you like me to share my deck? I have a presentation prepared. It takes about 6 minutes or 5 minutes or 7 minutes." But give specifics so they know. And then they can decide, yes, or I'd just rather have a conversation. Because a lot of investors too, they might just want to have a get to know you conversation before really diving into the specifics. So let them lead, see what they want to do. Don't put all the pressure on giving yourself the pitch and the deck. Assume that they wanted to see you present the deck, you present the deck, and then you have 5 minutes or so left over for questions. And then that's it. So make sure you have the follow-ups. There's often questions that you might not have the answers to right then and there. You can follow those up with an email Or you could say, let's schedule another call to go over those things. You should have a good sense if they want to continue the conversation at that first meeting. You won't likely have a, yes, I'm going to write you a check. If you do, great. You're lucky. That's awesome. Good job. If it's you may get a no, but a lot of investors don't want to say no right on the spot. I'll give feedback and say, look, this isn't for me. It's not a fit for my thesis or whatever. I don't want to waste people's time. And I always give a real reason of why I'm not going forward if that's the case. But everybody's different. So you have to respect that. Getting to the second meeting, you can use a couple different ways. You could say, I would love to follow up with these questions and walk you through them. I'd love to meet with your partners if there's other people involved that are making the investment decision. Or I'd love to walk you through the financial model. Or I could walk you through the data room and then you can go into it yourself, things like that. But the key is continuing to develop the relationship. So getting them on a call, buying them a coffee or asking their advice for something, but continuing to build and build and build, because that's what's going to get you the check at the end of the day. It's really about the trust that you have. We like to say that, these relationships are like marriages and they last sometimes longer than marriages, right? The 5 to 7 years, maybe 10 years until you get an exit. So building the trust up front is really important because when things go bad, you need to have that foundation
Mm.
there.
Do you ever see investors, though, that like over meet with founders where, for example, maybe I have seen investors, fifth meeting, sixth meeting, like it's just meeting after meeting, and then the investor actually never ends up cutting a check for the founder. Is that something that like you've seen? What are your thoughts there? What can founders do in those situations?
I've absolutely seen that. That is not how I am as an investor. I think it's terrible to exercise these founders in that way. I've heard horror stories. I had one founder, she was promised a $150,000 check, say like in June. So she stopped fundraising, stopped doing everything, just went to work in the business because this check was coming, the check was coming. Finally, 6 months later, she's went a little bit deeper in the due diligence on this person and found out that this person was actually a crook
Mm.
and was going to jail. So I don't know what that person's end game was in doing this exercise because they didn't get anything from the founder. But yeah, it's terrible. I mean, there's so many horror stories out there. We had a founder that we were working with, another founder who had this same thing. Person was going to write a $100,000 check and had been saying it. I said, well, did you send them the safe note? No. Did you give them a deadline on when you'd like the check? No. Did you did you ask them for their lawyer's information? Moving the conversation forward in that way can, okay, you said you're going to do it. Here's the document. Here's the information. Here are the wiring instructions. Here's the final things. Do you have any questions? Would you like to meet? You have to move the conversation forward. They're not going to say, okay, send me the safe and send me the wiring. Like you have to do that as the founder. If you feel like they are just exercising you and they continue to want to have conversations, you have to cut it off at some point. Another company that I'm a significant investor in, we had potential investor this is a European company. So there's well known in
Mm.
Europe, put it that way, not in the US. And they wanted all these special terms because they were a important person, quote unquote. And I said to the founder, this person won't let us discuss that they're an investor. It was very clear this person was going to do zero marketing, no help in PR, nothing. They just wanted to invest, but at special terms. If they're not going to bring anything to the table, why would we give them better terms than I'm getting, who's been an investor since day one, which is not fair. You keep having these conversations and you have text strings that are days long. You got to cut it. Got to cut and run. The end was, hey, I need a decision by this date. If you can't make a decision by then, I totally understand. We'd love to contact you in the next round. And never heard from that person again. People will do things, and this is like anything, right? This is why procrastination is a real motivator, because everybody waits until the deadline to finalize something. It's so rare that people actually get information back to people before a deadline, right? If you don't have a deadline, you're going to keep talking. You're going to keep finding reasons to chat or look at things or whatever. When your back is up against a wall, that's when you're going to make a
Mm.
decision.
What advice would you have for founders about when to put that pressure on the relationship? Because I think for a lot of founders, the trouble for them is like, okay, don't look at the investor like a check or a cash machine. But at the same time, they want to build the relationship, right? So at a certain point,
Mhm.
though, as you've pointed out, like there does need to be some sort of like pressure applied or a deadline put down. And what advice would you have for founders about like how to know when the time to do that is? Because that really is a pivotal point for the relationship in that, hey, either we're, going to do this or we're not going to do this. And we'll see you some other time or whatever it is. If a founder does it too early, I feel like it could totally ruin the relationship. It's just a lot of
Yep.
pressure. It's like in the dating context, it's the ultimatum of, hey, are we going to be together or not? So curious about your thoughts there.
I have two things. One is if you are actually closing your round, if you've got all the money or most of the money in and you're looking to stop the fundraising process and go run your business, set a date and stick to it. I'm closing my round on this date. If you're not in, I would love to keep you on my investor update list and you can come in the next round and the terms will change. And that you have to be confident that you're okay not getting that investor in if they don't write the check. One other thing I coach a lot of founders on, because there's so many, fundraising takes a long time these days. Yes, they're the people out there that raise in 2 weeks because they develop the relationships and they've opened their round and closed their round in very specific timeframes. Those people have done a lot of work. They're usually a little bit later stage. They know exactly where they are. Earlier stage companies, the rounds take forever. They just do. And they're a little more rolling. There will be a time when you can say, look, I've added this much value. I've built up the company this much more. So I'm going to continue to raise, but the terms are changing. So that's something you can say to somebody. Because of this progress, this traction, this new customer we've gotten, we are going to close the round on October 31st, open it again December 1st at new terms. Be done that way. Another thing, if you have people with smaller checks, even you say to them, if you write me my check, that $100,000 check, say it's $100,000. If you wrote me that $100,000 check today, I'm going to immediately apply that to this aspect of my business, this marketing, this development, this something. And that's going to increase revenue by X% over the next 3 months. We could continue talking for the next 3 months, or you can write me the check and watch my revenue
Mm,
grow. And you will be directly responsible for that. So showing them the impact that their money has, even if you're raising $1 million or 2 million or 5 million and they're writing a $10,000 check, showing the impact of that $10,000 immediately, they get so much ownership from that and feel like they were a part of a bigger thing because they know that helped impact
yeah, they
growth.
know that their money means something or like is important to the business, which sometimes can be also like it's a little bit of a double-edged sword, I would say, in some ways, because if the investor, like some investors, if they know how important their money is to you, they might be like a sense of entitlement sometimes, or like they use it as leverage, like, hey, you need this money. So I've seen it kind of work both ways sometimes. What are your thoughts about that in terms of having the investor know that their money is going to impact the business and how it's going to impact the business is important? But for like really early stage companies that really need that money, what are your thoughts on investors who might leverage how badly that startup might need that investment?
Yeah, if you sense that, I don't think that's a good way to start the relationship. Be willing to walk
Hmm.
away. I was at a panel discussion last week with the at the Canadian consulate, and there was a Canadian founder, and she was talking about how the investors that she's chosen, the strategic nature of them, who they are, what they do, how they help, has been more impactful than 2 times the dollars they actually
Hmm.
gave. So it's really about, look at them as a strategic relationship as well. Look for people that have experience that you don't have, or they've been there, done that before, and they can actually add value in different ways. You can call them when you need help with some issue, or you need a connection, or maybe you need another check. So it's about getting the trust built. If somebody's leveraging, saying like, I'm just trying to get a better deal from you because you're so desperate, it just feels bad, right? So I'd say use your gut and don't be desperate for the money, because investors smell the
Yeah.
desperation.
Yep.
It's, trust me, I've smelt it so many times. And I'm not going to invest in a founder that's that desperate, because if they are desperate now, they're going to be even more desperate later. They haven't figured out a way to get their runway in a good place. It's a very tough situation, because you don't want to throw good money after bad.
How would you coach a founder that is coming off desperate? I'm sure you've worked with founders at Power to Pitch that might, I mean, it's difficult, like when you're a startup founder, like you need money to grow your business. You need money to sustain your business oftentimes. And the nature of tech, and has for a long time, really been dependent on investment, to really get the ship running and going, which, there's the whole kind of bootstrapper versus venture back founder kind of two sides of the
Mhm.
coin there. How do you help founders move out of desperation?
One thing we recommend for every early stage founder, every single one, is to go for grants, because you can get some cash, it builds your credibility, and it builds your visibility. And credibility and visibility are the two things that you absolutely need as a startup that you don't have for the most part, unless you're a second or third time founder and you're Sarah Blakely and everybody knows who you are because you invented Spanx and now you have a sneaker high heel, and she's got credibility because she's
You
done it
like those
before.
sneaker high heels, by the way?
I wanna try them on. I haven't tried them yet, but the point being, if she came out with just the sneaker high heel, I think people would be calling her
Mm,
crazy. But because she's had previous success, people are taking her seriously. So she's already got the credibility and she's already got the
mm.
visibility. But so many other startups don't. So going for grants, even if it's 5,000, 10,000, 50,000, 100,000, you can get some cash, which gives you a little bit of runway, and it puts you in a less desperate situation. It also builds your confidence. Anything you can do to build your confidence, and that's a big part of what we do in teaching people how to talk about their company. It builds their confidence because they know how to talk about it. They feel confident in what they're saying. They've worked these words over and over and again, and they know that they're going to work. Just coming from a place of confidence is practice, 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 practice your pitch 50 times, 100 times, whatever it takes, practice, and getting clear and having good conversations with people where people are like, oh, I get this. This seems like there's something to this. I like it. That can be confidence building. But if you're out there talking about how you're revolutionizing the industry and there's nobody like you, people are going to roll their eyes. And then that's not going to give you
Mhm.
confidence.
Yeah, it's almost like using all the buzzwords is kind of like overcompensation for, what might otherwise be like vapor tech, for example, or, maybe you haven't actually really found your value proposition. Because if you truly were super clear on your value proposition, the way that you get clear on your value proposition is knowing exactly what your value proposition is and delivering it in a way that can be understood.
Nail
Yeah.
on the head. Yes. So we help with founders with grants as well. And we've had amazing success. We've had companies from tech to a subscription baking box to a peanut brittle company, from $1,000 to over $50,000. We have one founder that has won $90,000 in 3 pitches since June.
Wow.
That's huge for her business.
Let's talk about grants, because I think most founders don't really think about grants, because when most people think of grants, they think, oh, nonprofit allocations, for example, from foundations that are, typically for, charity initiatives, for example, or research projects or something like that. Do you think that do most founders probably don't think about grants, right? Like,
Or they think government grants, like, oh, I have to go to the National Science Foundation or NASA or somebody, and then it's a grant, but you have to pay for it first and you get reimbursed and you have to hire somebody to manage the whole government aspect and reporting and all that. So there's what we focus on are grants that come from companies or enterprises, or, whether publicly traded or private companies that offer grants to small businesses. And there are so many out there. There's a lot for women and other underrepresented founders, people of color, LGBTQ, et cetera. But there's also specific grants out there for people that are building certain types of tech, for example, things that are really going to help the world. And, there's grants out there for everyone. And I think that that's another misconception, that they're only for women or they're only for people of color. Absolutely not true. We have a program that's specifically focused on just grants. Plus, in our investor prep program, we help people with grants, but we offer a list. So we've compiled a list of, usually it's over 200 opportunities that every month that come out. And again, they range from 1,000 to 50,000, 250,000, even as high as 250,000. If you take the aspects of your pitch and how you're talking about it, it's the same exact application. Talking about things simply and clearly, answering the question that was asked, and telling them how you're going to use the money. Those are the three keys. Following the directions too. I mean, a lot of these grant applications will ask for a 60-second video, for example. So you use your 60-second pitch, but if you are 61 seconds, they will automatically disqualify you. If they have a certain word count and you go over, they will disqualify you. They're looking for reasons to disqualify people. And so people that don't follow directions, they automatically get thrown out. So the pool of actual qualified people that follow the directions is so much smaller than people actually think. So you've got a really good chance of making it. The thing that I love about those too is, it builds your confidence because you're getting up there, you're speaking about your company, whatever. If you're doing a pitch competition, opportunity to organize your business and how you're talking about it when you're answering certain questions. It's practicing for talking to investors. And then it's visibility. So think about these companies, like, for example, this founder that we worked with got a grant from Progressive Insurance. So think about Progressive Insurance highlighting this founder on their website and then doing a follow-up in a year and saying, what did you do with the money? This person won $50,000 from Progressive. What did you do with the money? How did it showcase your business? They're going to use that as PR. They want you to look good. And then they also know that you as a founder are going to go out there and talk about Progressive Insurance gave me 50 grand. They're awesome. Everybody should use Progressive Insurance. So it's an advertising thing as well as a tax write-off for them, but showcasing why you can make them look good is a way to win.
Can you paint more of a picture there? How can a startup founder paint a picture of how they'll make, the grant funder look good? What's one way that founders can think about that, for example?
Most of these grant applications have rubrics or specific criteria that they want to see, going after what they want to see and fixing the problem that they're hoping to help fix is a big way. If you are a man, don't apply to a female-only grant. You're not going to win. So go after something that you're going to fit, like go after something in your industry. You never know where a partnership could come out. So for example, my business partner, Kat, she won 22 of 23 pitch competitions grants she entered. One was the FedEx Small Business Grant. And this is for her previous business, which was a CPG business where she sent product through the mail. She was a direct to consumer and Amazon seller. She had a bunch of retail outlets as well, but a lot of her business was direct to consumer. So she was sending the product directly to the consumer from her parents' basement. She won the FedEx Small Business Grant because she talked about how she can use FedEx services to better her business, and not just their shipping services, but also printing marketing materials for shows that she would go to. There's a lot of these grants too, I should mention, will offer services in kind rather than just cash. Focusing on that, what can you do with that? I'm on the board of the Enthuse Foundation, which helps female CPG founders. It was born out of a group that is a marketing agency. They have a ton of marketing experts. So going in and talking about, for their pitch competition, how can you leverage their marketing? Or do you need help in the digital marketing scenario? Or do you want to do product activations? Whatever it is, talk specifically about why they will be helpful to you and not just in the money, about the money.
How can founders find these grants? Is there an easy way that you've developed that can help founders locate these grants? Is it as simple as just Googling grants for startups? What does that look like?
Kind of. I mean, there's services out there that you can pay. I mean, our service, we have an educational service that we provide that we want people, before they get access to the list of grants that we compile, they have to go through the program because we want to educate people on how to win them. Not, it's, you're not going to, if you just like throw a bunch of stuff out and see what happens, you're not going to win. There has to be a strategy to this. So that's what we teach people, is what is the right strategy, how to, we want people to be effective in this. Spend your time wisely. So we have a list that we provide. Yes, I think you can Google, but you never know. LinkedIn will post a lot. Like if you follow certain companies or certain things in your industry, people will post. I know I post a lot when I see them that I think would be helpful for people. So things like that, it's getting in the groove of them and then making sure it's the right thing. Like if it's $1,000 grant and you're spending 14 hours on it, maybe not the best use of your time. If the $1,000 isn't going to move the needle for your company. But if it's a $10,000 grant that'll take you 2 hours to fill out, you just made $5,000 an hour. That's pretty great, right? I don't make $5,000 an hour yet, but I would like
Me
to.
too.
You don't? You don't charge
Oh,
$5,000
it's
an hour for
wild.
your legal
It's
services?
wild. I know. I should.
You're so
I
cheap.
should.
I know you should.
Okay. So, anything else you want to share about grants that you think would be important for people to know out there?
I think I've shared a lot of the
Okay,
secrets
cool. Yeah.
already. Put together a process and a strategy for them. That's important. Just like your fundraising strategy.
So, circling back to founders raising funds, since the beginning of time in the world of startups, like a founder, and I really love talking to early stage founders because I feel like they're the people that oftentimes need, the most support and the most information and the most education and the most help. Because like once you like have raised a few rounds, like you pretty much know what you're doing and you become like a pretty honed in founder, and oftentimes you have a lot of support for you. So I really love focusing on like early stage founders often, because that's like, I also have been an early stage founder quite a few times, and like I just know how hard that process is. To go back to the question, for early stage founders, I think since the beginning of time, you think of a startup idea, and then the first thing you think is, I'm going to go out there and I'm going to raise a bunch of money for this startup idea, right? A lot of the times I'm having conversations with founders where I'm like, you don't need to raise money. Like if you can figure out some other way to, validate this idea first. I mean, the terms that you're going to raise at are going to be so much more favorable. It's such a better process if you really strategically raise capital. And one aspect of strategically raising capital you mentioned, one really important aspect of raising strategic capital is aligned investors. It's not just about the
Mm-hmm.
money. I think a lot of founders often overlook that and they think it's just about the check because, oh, money solves all problems in the world of business, or so
Right.
so often founders think that. So what would you say to the founders out there that are, maybe a little earlier stage, that are considering raising capital? How would you advise them about when to raise capital, what to raise capital for, so on and so forth?
There's so many founders out there that think that raising money is the only way to go. Only 1% of small businesses raise VC money. It just gets the headlines. And that's what people think they have to do because that's what they see in the papers. You're absolutely right. If a founder wants to run their business forever and pass it down to their children, do not take investor money because they want an exit. They want you to build, scale fast, and sell so that they get their return. You have to think about, what is your business model? What is your exit strategy? What do you want to do with this business? And then consider raising. In terms of the environment today, you're absolutely right. You need some sort of proof of concept or some sort of traction out there. Yes, a few years ago, people were getting funded on an idea, but that's not happening right now. You need to prove that the problem is bigger than you and your buddies and that it's so big, it requires a big solution that's going to cost money and it needs investment, but it has the potential to 10x, 100x, a billion X times the investment from your investors. We tell this to people all the time. I say this even as an angel investor that loves to invest in startups. A founder doesn't need to raise. I say, oh my God, this is so great. I get so excited when a founder says, I'm not raising right now, or I'm not sure if I'm going to raise. I'm like, okay, great. How can I help you otherwise? Like, this is great because you're not asking me just for money. You're asking me for other things. It shows me that you're gritty. It shows me that you understand what it means to take somebody else's money, because that taking somebody else's check, you are then holden and responsible for the steward of making them more money. That's what you signed up for. So if you don't want that pressure, you think there's a lot of pressure on you now trying to build the business. Oh my God, take on investors. Then the pressure starts, right?
Yeah, I've been making a lot of memes. So like anyone out there,
Oh, I
yeah,
didn't know
yeah.
that.
Like I've been going really hard on the memes, and I made this meme the other day that's like startup founder leaves their 9 to 5 corporate job because they're sick of having a boss, and then has customers, investors, so on and so forth, all as their bosses. If you're out there, check out my memes. They're awesome. I think they're hilarious. If you have memes, send me memes. Katie, send me memes. All the people out there, send me memes. I love memes. So to go back to the conversation, investors, a lot of pressure, decision making, gets changed. The company isn't, only solely in your hands. Investors get a say in certain decisions that are being made. It fundamentally changes the very nature of the company. I think the market right now is actually really trending more towards bootstrapping anyway, for the most part, especially for at least founders that have found market fit. I'm not
Mhm.
really finding too many founders wanting to go raise capital. And it's really interesting. I don't know if you've seen the recent PitchBook data, Katie, that they just put a report out and they analyzed the last 10 years or so of venture capital. Well, in 2024 to date, there's been about $170 billion worth of venture capital issued. Now, compare that to 2014, 10 years ago, there was about $70 billion worth of venture capital issued. So a lot more venture capital issued, but the number of deals are
Mhm.
significantly less in 2024 than they were in 2014. And the reason for that is the Series A rounds and the later stage rounds are getting much, much larger, and the early stage investments just aren't happening prevalently as they have been in earlier years, as you mentioned, where you could raise off of like a sexy pitch deck or just an idea, for example. That's just not the nature of the market for various reasons in terms of where we're at now.
Frankly, I'm not surprised at when after your analysis makes sense to me. These Series A, B, C rounds are so
Hmm.
huge now. Well, and then you've also got the people that are doing bridge rounds and can't really make it to the Series A and things like that. So that's tough. But yeah, the early stage founders, if you can find traction in other ways, and it doesn't necessarily have to be revenue, it can be signups for emails of waiting for your product to launch. It can be letters of intent from groups that are willing to pay for your product when it comes out. So things like that can show traction and show viability of the business when you're talking to investors. And plus, there's so much low code, no code stuff out there right now that if you can do something a little bit manually, a little bit no code, then really raise money to do the full automation of something after the concept is proved, that's a good way to go.
Yeah.
Don't raise any more than you need. I mean, I know people say they're going oversubscribed and all that, but knowing where every single dollar is going to be spent is so important for founders. Investors want to know that you are going to be gritty with their money and that it's the things that it's going to is going to revenue growth or customer acquisition or things that are going to drive the bottom line, increase your subscribers or your MRR or ARR, because that's what gets you multiples on an acquisition,
Yep.
right? So we love Forecaster for that
Yes.
modeling, don't
Shout
we,
out
Omeed?
Forecaster and Logan and the
Yes.
whole team and Jeff and Steven and all of them over there. Super
Yes.
awesome. Logan was a previous guest on this podcast as well. So if you're listening to
Oh,
this, I think
yeah.
his episode was a few episodes back. But yeah, Forecaster,
He's
awesome.
awesome.
Well, it looks like we're at time now. And this has been a really lovely conversation, Katie. Thank you so much for coming on the show and joining us here.
I have loved it. Thank you so much. And thank you for accommodating Nacho. I'm not sure how much he's going to make it into the end, but there was a dog on here. If people aren't seeing it, he's very cute. So thank you for being tolerant of Nacho, Omeed. I really appreciate it. But no, great conversation. I love that you're doing this. And thank you for letting me chat so
Yeah, of
much.
course.
I really enjoyed it.
Pleasure.
And I'm excited to see the memes
Yes,
too.
check the memes out and let me know what you think. For all the people out there, check the memes out. Send me memes, like I said. But yeah, Katie, really enjoyed the conversation. For all the people out there, her contact information will be in the show notes below, so you'll be able to reach her. If you ever contact me and you're in the fundraising process and you're like, I don't know how to pitch, like, I'll always refer you to Katie anyway. And I've been definitely letting people out there know that they need to come see you to hone and craft and refine their pitches. A lot of good information in this episode. Can't wait for people to listen out there. And for everyone out there, thanks for joining another episode of the SaaS Buyers Club. We'll see you next week.
Thank you.